Welcome back, everyone. This is the first discussion video for chapter 13, our last chapter. So I thought I'd start off this one with a few review questions that look back to some pretty early stuff, just to keep that a little bit fresh as we head toward the final exam here. So which type of costing system would Coca-Cola be most likely to use for tracking costs within its beverage operations? Job order costing, process costing, or either one? Pause the video, think about that for a second, and then come back for the solution. Yeah, Coca-Cola would be most likely to use a process costing system. Remember, process costing systems are most appropriate for companies that are making products that unit to unit are homogeneous or the same. So Coca-Cola, when they're cranking out their millions of bottles of Coke Zero that I love so much, each one of those is supposed to be kind of identical to the one behind it and in front of it. So they're going to track cost in that type of process costing manner. Job order costing, on the other hand, more appropriate for firms that are doing something that's sort of made to order, customized in some way, or things that are unique. Next up, suppose in looking through a company's cost records, you see this following entry: a debit to manufacturing overhead for $4,000 and a credit to some other account for that same $4,000. Which of the following accounts shown here could not be the credit side to this entry? Again, give this a pause, think about it a minute, and then when you're ready, come back for the solution. So our answer there is E, work in process. When we apply overhead, we apply it to work in process. And this entry would be flipped if this represented the application of overhead, right? We'd have work in process being debited for $4,000 and overhead being credited for $4,000. There is no normal entry that has a debit to overhead representing actual or incurred overhead and a credit to work in process. So that does not fit there. Everything else could be on that credit side. If it was materials, we'd be talking about the use of indirect materials. It's accounts payable, we'd be talking about some other overhead cost incurred, something on account. It could be factory property taxes, insurance, whatever. It could be cash, again, if we were paying for some overhead cost with cash. And could be wages payable if we were talking about indirect labor costs. Last one for now here. Last year, XYZ Corp had total estimated fixed overhead costs of $50,000 and estimated their variable overhead cost to be $1 per machine hour, the allocation base used to apply overhead in their system. The company also estimated that production for the same period would require 10,000 total machine hours. At year end, an examination of cost records found that overhead was over-applied by $5,000. If actual machine hours for the period were 10,500, what was the actual overhead cost incurred for the period? Pause this, work through that problem, and then come back for the solution when you're ready. The answer there is B, $58,000. So the first thing we want to do is come up with this total estimated overhead at the beginning of the period. That's the fixed piece of $50,000 plus the $1 variable piece per machine hour times the 10,000 estimated machine hours that would be run, so a total of 60,000. Then we'd find our predetermined overhead rate in this system. That'd be the estimated overhead of 60,000 divided by the 10,000 expected machine hours, or $6 per machine hour. Applied overhead for this whole period then would be the $6 per machine hour rate times the actual number of machine hours run, 10,500, for a total of 63,000. Okay? 63,000 minus the 5,000 that we are over applied by in this case means that actual overhead cost incurred must have been the difference, 58,000. All right, moving on to some new material then. Chapter 13 was titled Differential Analysis, the Key to Decision Making. Our first learning objective was to identify relevant and irrelevant costs and benefits in a decision. So our first key concept here is that every decision involves choosing from among at least two alternatives. Otherwise, there's no choice, right, or no decision. So the first thing we want to do is to define the alternatives being considered. Once we've done that, we need to identify the criteria for choosing between our various options. Now, for our purposes here, we need to define relevance. And relevant costs and relevant benefits are those that should be considered when making decisions. irrelevant costs and irrelevant benefits, as those terms would suggest, should be ignored when making decisions. Now, generally speaking, the key to effective decision making is some differential analysis, and that's just a way of saying focusing on future costs and benefits that differ, that's the differential piece, between the alternatives. Everything else could technically be considered irrelevant and could be ignored. So a future cost that differs between any of our alternatives is known as a differential cost. If we're talking about a revenue item, we just call it differential revenue. An incremental cost is another way to describe a differential cost, although we're talking specifically there about a cost that's increasing or greater between two alternatives. And then an avoidable cost is any cost that could be eliminated by picking one of our options or our choices over the other. Now, a term we introduced way back in Chapter 1, and you may be familiar with from other classes as well or other things, are sunk costs. That's a cost that's already been incurred in the past. It can't be changed no matter what we do going forward. Because of that, those things are always irrelevant when choosing among alternatives, at least for our purposes here. And then key concept 5, we've already really hinted at. Any future costs and benefits that don't differ between alternatives are irrelevant to the decision-making process. So that'll be our key in defining relevance. If it differs between two or more alternatives, it's relevant. If it does not, it is irrelevant. Now, opportunity cost, that's another term we've used before. They also need to be considered when making decisions. An opportunity cost, you recall, is that potential benefit that we're giving up by picking one alternative over another. So let's see if we can answer a couple questions here. First up, sunk costs are blank relevant in decision making, while variable costs are blank relevant and fixed costs are blank relevant. See which one of these you think best fits there. Pause the video and then come back when you're ready to check an answer. Our answer there is B. Sunk costs, as we said, are never relevant in decision making, while variable costs are sometimes relevant and fixed costs are sometimes relevant. The key point we want to make there with the second and third blanks here, we can't unequivocally say that cost behavior relates to relevance. There could certainly be variable costs that wouldn't differ between alternatives, and there could be fixed costs that do differ between alternatives. So it just depends on what type of variable costs and what type of fixed costs we're talking about, whether they differ between alternatives. If they differ, they're relevant. If they don't differ, they're irrelevant. Next, which of the following would be relevant in the decision to sell or throw out obsolete inventory? 1, the direct materials cost assigned to the inventory. 2, the cost of disposal of the inventory. Again, give this a quick thought here, pause the video, come back when you're ready for a solution. So the answer there is C. The direct materials costs assigned to the inventory are not relevant in this decision to sell or throw out the inventory. Point being, they are sunk costs. Right? They've already been incurred to produce this stuff. Now our decision is something moving forward. Are we going to try to sell it for some reduced price maybe? Or do we have to pitch it, maybe even have to pay to throw it away, some disposal cost? So that's what number 2 was, the cost of disposal of the inventory. So because we would incur that to throw out the inventory, but wouldn't if we were selling it presumably, that is relevant in this decision to sell it or pitch it. So with this idea of differential analysis, let's compare what we'd call like a total cost approach versus a differential cost approach. And let's use an example here. The management of a company is considering a new labor-saving machine that rents for $3,000 a year. Data about the company's annual sales and costs with and without the new machine are shown here. So here's the current situation, the first column. Second is the situation with the new machine. So we can see there that we're cutting some direct labor costs. Right? No change in materials costs or overhead. And then we're paying some kind of fixed rental charge to do that. Now the differential costs and benefits then in this scenario are only those that differ between those two choices, either not adding the new machine or adding the new machine. So it's just those two we hit on the way down the line here. The change in direct labor cost, $15,000, versus the rent on that new machine, the $3,000. So really the only parts of this data that are relevant for this particular decision are those that differ. this direct labor cost and that rent cost. We can boil down the decision to those 2 points. We don't have to really think about all these costs and revenue items that don't change between either alternative. We're just sort of muddying the waters if we do. So because of that, we can get a quick answer on whether buying this machine is worth it. We'd have a decrease in labor cost of $15,000 versus an increase in fixed rental expense of $3,000. And there's our financial advantage of renting the new machine. I believe I said purchase earlier, but this was a rental. $12,000. So it's to our benefit to undertake that. Now, using this differential approach is desirable for at least 2 reasons. First, it would be somewhat rare that enough information would be available to put together full detailed income statements for both alternatives. And then second is probably even the more important one, mingling these irrelevant costs with relevant costs may cause some confusion or at least distract managers in this decision-making process from the critical pieces of that decision. So it's sort of just an idea of removing things that are superfluous or unnecessary, just to save, processing time and some cognitive load. So that brings us to learning objective 2, which was to prepare an analysis showing whether a product line or other business segment should be added or dropped. And we talked about this a bit in chapter 6 with our segmented income reporting. And we're going to stick to the same general rules we followed then. So our decision rule will be that a segment should be dropped only if overall profit would increase. So a firm could compare their contribution margin that would be lost, or a segment margin, if you remember that term from chapter 6, if a particular line was discontinued, to the fixed expenses that could be avoided if that same line was discontinued. So let's look at an example here. Let's say we've got a watch segment in our business, generating sales of $500,000, contribution margin of $300,000, and right now we've got total fixed expenses on its income statement of $400,000, so it's showing a net loss of $100,000. Let's say, though, that investigation revealed that the fixed general factory overhead and the fixed general admin expenses, so this $60,000 here, general factory overhead, and then general admin $30,000, could not be affected by dropping the digital watch line. In other words, those would just be reallocated to other product lines. They wouldn't really go away. They're not avoidable if we drop the watch segment. Let's also assume that the equipment used to manufacture these watches, so let's say they're digital watches, has no resale value or alternative use. We can't use it for anything else. We can't sell it. So should the firm retain or drop this particular segment? And here's one way to go about this solution, and it is consistent with our segmented reporting in chapter 6. We take the contribution margin that's lost if watches are dropped, $300,000, and compare that essentially with the fixed costs that are avoidable if that same segment is dropped. So it's the salary of the product line manager, $90,000, the advertising cost, $100,000, and then the rent, the factory space, $70,000. It's not the general admin and the general overhead costs, right? It's also not the depreciation for that equipment that can't be used for anything else. So in total, that's $260,000. The difference then is a disadvantage of $40,000 if we discontinue that segment. Okay, so in other words, the watch segment here is contributing something positive to that overall company bottom line. So if we drop it, we're going to be worse off in total. We can also come up with that same solution by preparing comparative income statements, showing sort of a keep and drop scenario. So here is what that would look like. Keeping the watches, we've got the full income statement there, $500,000 in sales, all the way down to this on paper net loss of $100,000. But up to that contribution margin line, we see that we're losing $300,000 in CM if we drop the watches. On the other hand, that general factory overhead continues under both alternatives, right? We can't avoid that fixed cost. Salary of the product line manager, though, that does go away, so there's a difference. Depreciation does not. Remember, that's a sunk cost. We can't use this equipment for anything else. We can't sell it. We can't do anything with it. And then we've got the advertising and the rent that would go away if we dropped the watch segment, and the general admin expenses that would not. So that complete comparative income statement shows essentially the same thing. The The company is worse off by $40,000 if it drops that watch segment. And one thing this example highlights is we need to be really careful with our allocation of fixed costs. Allocating fixed costs, especially those unavoidable ones, can distort this keep or drop decision. Including those makes product lines potentially appear unprofitable, or at least less profitable in other cases, when in fact dropping those product lines would hurt the company's overall profitability. And I'm going to stop the first discussion video there, review anything you need to, and as always, feel free to ask questions before moving on to the next one.